We're going to do that. The chapter 2 handout. And what we're going to look at is the transactions and how the transactions will actually change the financial statements. So if you think about it, like I think the first transaction is if you take cash and buy land. Notice we made the financial statements, we made the balance sheet, we had cash, a certain amount of cash, we had a certain amount of land. Well, if we make a transaction where we take some of that cash and buy some land, notice that that changes those accounts. It changes the balance sheet. So transactions are anything that changes the financial statements. If it doesn't change the financial statements, it's not a transaction. For example, let's say I order some merchandise. I ordered the merchandise, but they haven't sent anything yet. Until they send the merchandise, there's no transaction. You know, if nothing ever happens, I order it, they never send it, no transactions happen. So only when it actually a transaction happens, it'll actually change the financial statements. That's what we're talking about when we're talking about the transactions here, that they'll actually change the financial statements. Okay. Use cash to purchase land. Okay, our cash is going to go down by 300. Our land will go up by 300. Number 2, paid cash for equipment. Okay, kind of the same thing. Cash is going down, 400. And our equipment is going up by 400. Okay, number 3, supplies were purchased on account, 200. Okay, so our supplies are going up, but we haven't used any cash yet. We bought them on account. So we owe somebody $200. So that's going to be our accounts payable. It's going to go up because we owe $200 more now. Our liabilities have increased. Purchase a building and land using a $3,000 mortgage. Building and land, building is 2,000, land is 1,000. Okay, so let's see here. Building 2,000. Land is 1,000. And again, we didn't use any cash. We used a mortgage. So we'll come down here to mortgage payable. Borrowed cash from the bank using a notes payable. Okay, so we borrowed the cash, and initially, we signed the note and they gave us $5,000 cash to work with. We're gonna have to pay it off eventually, but initially we'll get the $5,000 to work with, and our liabilities will increase by 5,000. I want to show you something here. Let me do something. Sorry. I want you to notice something here. These are the changes that we were making. And notice that the asset side has to balance, no matter what the transaction is, it has to balance with the liabilities and equity side. So the first two were all in the asset accounts, one trading one asset for another. But you'll notice that these are still in balance because as one side goes up, so does the other side. And this is something that's true about transactions because we have this balance sheet. There has to be at least two accounts. Because if the balance sheet has to balance, so if you only change one account for whatever number, it's not going to balance. So there has to be at least two accounts. Sometimes this is called the double entry system, that there has to be at least two accounts. Because if there aren't two accounts, there's no way the balance sheet's going to balance. Okay, number 6. Issued common stock for cash. Okay, so issue just means that we sold it and we sold it to the owners. So we're not selling any merchandise or anything here. What we're selling is ownership. So they got cash and now we have more owners. We have $2,000 more owners. Some is a little bit of a tricky one. Received cash from a customer previously billed. Okay, a customer previously billed would be an accounts receivable. So this customer must have owed us $500. So we got this customer's accounts receivable on the books for $500, and now they're paying it. So they no longer owe us the $500. So we have to take the accounts receivable off the books and take the cash. Now, don't get me wrong, we'd rather have the cash than the accounts receivable, but we have to take it off the books. So the accounts receivable is going to go down by 500 because they no longer owe us. And our cash will go up by 500. Customer paid cash towards their account. That's the same thing. So they paid cash towards their account, $100. Okay, so they no longer owe us for 100. It's 7 and 8 are the same. It's two ways of saying the exact same thing. So. Paid off a few of the accounts payable. Okay, so this is us paying off the accounts payable. So we paid them with cash. Magic word paid tells you that it's cash. Okay, so this will be negative 400. And accounts payable is also a negative because we owe $400 less now. Doesn't tell you what our total amount of accounts payable was, but so we copy this over. The assets went down by 400, but so did the other side. Lastly, very similar one, made a payment. Okay, payment, what do we pay with? Cash. You guys heard that? That little dog crash upstairs. All right, so made a payment, so negative 1,000. And our mortgage payable now goes down by 1,000. So now we owe less of that mortgage payable. And so notice that, for all of these, they're going to be the same. And that if one side changes, then the other side has to change also. So for every transaction, at least 2 accounts. It could be 3, it could be 4, it could be 10, but there has to be at least 2. Okay, let's go do some more of these, and now we're going to be a little bit trickier though. And it's a little bit trickier because obviously we haven't done anything with the income statement yet. But now notice, remember from our last class that we had that chapter 1, I should say, the income statement had revenues and expenses, and that went into the retained earnings statement. And then there was also dividends in the retained earnings statement. And those retained earnings ended up on the balance sheet. So revenues, expenses, and dividends will eventually end up, the accounts themselves won't end up on the balance sheet, but retained earnings will. So those go into, they'll eventually flow into retained earnings. So when there's a transaction, it's going to change the balance sheet through the retained earnings statements. So revenues will be added, expenses and dividends will be subtracted from the retained earnings. It'll make more sense when we go through it. Okay, receive the utilities bill. Okay, we haven't paid it yet, but now we owe $200. And down here, I'm going to put the different accounts that we have. So this will be revenues will be a plus. Expenses will be a minus. And dividends will be a minus. And those will eventually again flow into that retained earnings here. So in this case, we have an expense. And the retained earnings will go down by 200. Copy these over. Okay, owe employees for 1 week's wages of 1,600. Okay, so wages payable, we owe them 1,600. And again, that would be an expense. It will eventually end up in retained earnings. So common stock to an investor. I'm sorry. Learning how to talk here. So we sold common stock. Okay, so we got cash for that. But now we have more owners. So the assets went up by 3,800, the owners went up by 3,800. Pay dividends to shareholder or stockholders, excuse me, 1,800. So we paid them with cash. Again, we never see paid Paid means cash. Oops. And that will come out of our retained earnings. Like that piggy bank thing, remember? Was you trying to forget it? Oh. We still balance, and we should. So again, there always has to be at least two. Build, perform services for cash. Okay, so we did some services, whatever they were. And this will be a revenue. Revenues are good. Owners like revenues because it, oops. It'll increase the money they put in their pocket. So okay, 16 is a little bit tricky, and we'll talk about that in a second. Build customers for services delivered. Now notice it says build. So this is, we haven't been paid yet. This is going to jump ahead a little bit. We actually have a chapter that talks about revenues and earned revenues and all that kind of stuff. Revenues, we recognize revenues when they're earned, not when we receive the cash. So if we do our part of the job, we count it as a revenue. Okay, so we put an accounts receivable on the book saying, okay, we did our part. So suppose I mow my neighbor's yard for $20. The neighbor hasn't paid me yet. My part is done. I count it as a revenue. Okay, so it's when it's earned, not when the cash changes hands. So when it's earned, we count it as a revenue. And so that's what we're going to do here. And the revenue will go right into retained earnings. Okay, so let's see here. Bill a customer for services delivered, so we bill them. So that'd be an accounts receivable, 550. We're also going to add that into our retained earnings because that's going to be a revenue that will eventually get into retained earnings. Sale of services made to customer on account. That is exactly the same one we just did. Just another way of saying it. Sometimes you get, I don't know. Sometimes you'll have people say things in a different way in a book or something. But it's exactly the same thing. Sale of services on account. They haven't paid us yet. We still count it as a revenue because we did our part. Paid the current month's rent. Okay, paid. So we're talking about cash. And that will be an expense. Rent expense. Oh, I forgot to put it in. Purchase supplies on account. So supplies went up. We have 160 more of supplies. We purchased it on account, so we owe more. We owe 160 more. paid for the supplies purchased on account. Okay, so we paid for the supplies purchased on account, so we paid them with cash. Notice we didn't get any more supplies. We're simply paying for it. And we will take out 160 out of here. Okay, so that's the, basically the transactions. And again, there has to be at least two accounts and the two sides have to balance. So if one side goes up, the other side has to go up by the same amount. One side goes down, the other side has to go up by the same amount. Sometimes it happens all in one area versus cash. Use cash to buy another asset. That's just all happening in the assets, has nothing to do with the other side. But it'll still balance up, as long as it comes out to zero, it'll still balance. So there also has to be at least two accounts. There could be more, but at least two and for each transaction. Okay. And this, the third problem here we're going to have is ratios. And this is basically a brief introduction to ratios. What are ratios? Ratios are used to determine how well a company is doing. And it's also good for comparing companies. And the reason why that can be difficult is there are no two companies that are the same. They're all run a little bit differently. They all are different sizes. There are no two companies that are exactly the same. Target is different than Walmart. They're different sizes. They have different policies. They have different ways of doing business and all that kind of stuff. Now, we have to, if you're looking at, geez, do I invest in Target or do I invest in Walmart? It's good to know how to kind of quantify it, how to kind of make some sense out of it. And that's what we use ratios. And ratios are rely on the fact that there are relationships between numbers that make sense. For instance, the more sales you make, probably the more net income you have, right? The more you sell, the more net income you have. So there's some relationship between net income and sales. And you find that with a lot of things on the financial statements, and they're just trying to make sense. Now, this one I'm giving you is not very in-depth. We actually have a whole chapter on it later, but this is kind of an introduction to ratios. Just kind of as a getting our feet wet, shall we say. Okay. And another thing about ratios, the actual mechanics of ratios is kind of like baking a cake. They say, go get this, go get a cup of flour. Okay, you'll get a cup of flour. Okay, mix in, 3 teaspoons of salt or whatever. Same thing. They tell you to go get it, and you put it in the formula, and you can chunk out a number. Okay. So here are our ratios. I'm going to make this a little bigger for now. Actually, I'm going to bold this so we can actually see it. Hey, look at that. See, I told you guys there was numbers there. Okay, so for each of these ratios, we're just going to plug in these numbers and see what it comes out to for the ratio. We're not going to go too in depth on this. We'll talk a little bit about it. But so let's just do it. Now, again, it's kind of like baking a cake. You go, okay, we need net income for 2021. Okay, so I'm going to go grab the income for 2021. Yeah, that's not centered. And then says get the shareholders' equity. Okay, let's go get the shareholders' equity for 2021. Okay, so now I'm going to put in a formula here. We'll say 50,000 divided by in this case, E9, I don't know if you can see this or not, E9 divided by E10 says 25%. We're gonna do the same thing for 2002. Okay, we need the net income, 62,000. Hey. I'm not formatted these like I wanted to. And the shareholders' equity. And I'm just going to copy this cell over here. So this would be the return on equity. Now, the return, you probably want that to be high, right? I mean, more money is better. And generally speaking, when you talk about ratios, if there's good things on top, income, sales, that sort of thing, usually you want it to be higher. So good stuff on top means that it's good. Usually that's the case. Okay, return on assets, net income. So 2021 net income is 50,000. And we go grab total assets, 360. Again, I'm just going to copy this cell. Copy. Paste. Okay. I assume you guys know how to copy and paste. You'd be in a grad course if you didn't know how to do that. But okay. And net income for 2022. And we're going to go grab our total assets. And again, I'm going to copy and paste. Copy. And again, this one kind of the same way, income's on top. So if there's good things on top, you want it to be higher. So it looks like 2022 is a little bit better than. Okay. Net income over sales. Copy. Paste. Income. Over sales for it. Oh, there's only 4, there's 5 here. Okay, assets to shareholders' equity. It's not a ratio. This one I don't think is a percentage. Just gonna do it. Okay, so total assets. Shareholders' equity. They talk about this being financial leverage, in which we're not going to get too much into. It's basically how much of other people's money do you use, and yeah, obviously there's a relationship between equity and the assets and of how much money you're borrowing, because assets equals liabilities plus equity. So the smaller equity that you have for equity means the more that you have in liabilities, which can be more profitable, but it can also be riskier. And you'll find that in business in general, that's the way it goes. Something that's riskier has a higher potential for income, but again, it's riskier. So it's kind of a more of a measure of risk than necessarily a profitability, something like that. Okay, and sales to assets. Okay, let's see our sales. And you could just grab these out of the other ones too. Assets. And this one is sort of like how much in sales do you get for every dollar of assets? So you get 83 cents versus 87 cents. Obviously, you want more sales. So more sales, the better. Yeah, this is kind of just kind of an introduction to the ratios. We actually have a chapter that gets far more involved in that. I think it's chapter 4. Yep, chapter 4. Okay, so that is chapter 2 handout. And again, turn that in, get your extra credit points. To turn it into Blackboard and get up to 10 extra credit points added on to your score overall. And not only that, it also, when if you're going through these handouts are very similar to what you'll find on your homework problems. So it'll help you with the homework problems too. And that's really the point. While I do give extra credit points, the real points come from being able to do the homework. Okay, well, I will see you next chapter.